Well, good morning, everyone. Welcome back to our daily trading room, our DTS trading room. Hold on here one second. I'm going to get you my monitor. The market's just opened up, and it looks like it was a fairly strong open for the most part. Just one second here, and we'll take a look at uh, where the market has been in the overnight. Okay, it looks like my monitor should be displaying. And let's go here. Well, let's start here with the Eagle. So we can see that, where did the market leave off yesterday or on Friday? So the market left off Friday down here around the 42.50 mark, give or take, and floundered a little bit, but we've opened up here. So we've got a little bit of an opening gap right down here, something to bear in mind that the market may try to get into that gap if it gets below, where's the 630 mark? So if it gets below the open here. Right now, however, it does appear as though we are in a little bit of an uptrend. You can see from the overnight, the market opened, and it does appear as though traders are trying to rally the market somewhat. In fact, I'm going to throw a trend line across the highs and the lows here to try to get an idea if the market starts to get a little bit shallow or if it, in fact, continues to honor that trend line. Of course, the market just opened up, so we don't want to get too excited here. It looks like we're getting a red bar buy signal here in the hawk. That tends to develop near the end of a trend. And of course, the red bar buy is one of these signals that we can actually trade counter trend. It is our counter trend signal. So you could set up for failure of that to look to sell it. And it looks like, oh, we might get two contracts on that. Maybe I'll put a runner in on this one. Just give it a little bit of a go. We're getting a test of the extreme, perhaps, with this lower high right here. And we'll submit that order. This is, again, a little bit early, but it does look as though the market might be trying to get into that opening gap. Getting a trend change signal here, or the makings of a trend change signal on our Falcon also. The trend change signal, for those of you who are Falcon traders, who have the Falcon with your trading package, this is a very high probability signal. In fact, I'm going to set this one up also. I'm going to take it below the low. I'm going to cover it above the high. So I'm going to do it a little bit differently than the hawk trade. But this is one of our high probability signals, the trend change signal. And it occurs quite simply where the trend line changes color. So in this case, it's gone from green to red. And we have this down, up, down pattern. And the down portion is the portion that changes the trend line. Then we have the buyers trying to fight the market back, and we have the sellers coming right back, pushing the market lower again. Here's the same idea, the trend change signal to the upside. So trend line goes from red to green. Here's the up, here's the down, here's the up. There's our signal, and you can see there was a pretty nice progression out of that one. So we've hit our break-even trigger now on the Falcon, and it looks like we're going to, well, hopefully drift low enough to find our profit target. I hope those 2 or 3 ticks I gave up there aren't going to leave me hanging. No, there we go. So we hit that profit objective, and it looks like our hawk trade is starting off pretty well also. Hit our first profit target here, have the rest of the trade at break even. Now we're getting our first micro macro cross signal. And it, oh, come on. Come on, give me that little bit of a swing there. Don't take me out just yet. There we go. Get down there. There we go. Get into that gap. Okay, now that we're progressing a little bit, I'm going to try to turn on my trailing stop, and I think I'm going to use the parabolics. They're a little bit more aggressive, a nice system to use, a nice strategy to use when you have a market which is trending. It's going to hold you in for the better part of that move. And where did we say that gap was? At around the 42.70, 75 area. Let's see if we're able to reach that. Our first micro macro cross signal, by the way, also found its profit objective. If you took advantage of that first micro macro cross, again, a high probability signal as far as the hawk is concerned. So I've got a little bit of a chance here. Come on, get on down there. As the market tries to get into that opening range gap. Good morning, Jim. Jim shooting us some advanced decline numbers here this morning. He says there's about 1,800 on the buy side and 800 on the sell, but don't forget that big gap out of the open is going to skew those numbers a little bit. So you don't want to focus on those right, just on the raw values. So a little bit of a reversal there, got tagged on the parabolic. We'll see here in a moment whether or not I would have done better to perhaps go with something like the ATR. The ATR would still have held us into this trade, but probably I think I did okay with the parabolics. Yeah, that's all right. That's okay for an opening trade. Certainly on the hawk, anytime you can pick up nearly $200 on the hawk, that's nothing to sneeze at. You can see we've violated this channel also that we've drawn here on the eagle, suggesting that the market is starting to break down a little bit. We should get another opportunity here in a moment. In the meantime, let's take a quick look here at the crude oil market. This is the eagle on crude oil, and believe it or not, I can't believe I'm saying, let's sell crude oil here at $32.50. Aye, how much lower can crude oil go? Well, there you go. You might want to, pay attention to this trend line here. You may choose to short below that trend line versus the hash mark, but because crude oil is so expensive, or at least for my account, I'm usually restricted to covering crude oil fairly tight, which does make it a little bit problematic at times. All right, so it looks like crude oil trying to head lower now, and we'll see whether or not we can get below this trend line. I'm going to pull my break-even trigger just a little bit lower to try to give this trade a little bit of room. So we'll throw that on the shelf, but there's an opportunity brewing in crude oil on the eagle. I'm also watching gold this morning, but remember, I'm happy to take a look at any market which is of interest to you. And now we're just kind of on hold for the moment until we get another opportunity. And it does look as though the parabolics work just as well as anything. If we had stayed with the ATR stop, we would have been stopped out regardless on this pullback, which has drifted into yellow bars here on the eagle, yellow bars, pardon me, on the hawk. the yellow bars, we do tend to ignore those. Crude oil still trying to get down here a little bit. And if my crude oil trade pans out and hits my profit objective, that would be my day. I would be done. Because we picked up almost 200 on our Hawk trade, another 100 on our Falcon trade, and this is a $400 trade. So almost $700. That would be enough for me. No point in getting greedy. All right, so that trade's still trying to get down to its break-even target. We are getting another first micro-macro cross signal here on the Hawk. The signal printed right here. It did not engage just yet. And now we're hitting into a little bit of a macro pullback phase. Let's shoot a trend line across the tops here also. Well, hi, Ryan. Ryman is new in the room. Welcome. Ryman says he's a Raptor owner. Okay, and he's normally trading the E-mini. All right, I can pull up the E-mini here on the Raptor also. Now, everybody's always asking me, Eric, why don't you follow the E-mini? And it's a fair question. There's nothing wrong with following the E-mini. But I find that dollar for dollar, I get more bang for my buck with the NASDAQ or the mini Dow, both of which, of course, will follow the E-mini. And I'm just loading the E-mini on my Raptor chart. So bear with me a moment. It's taking its time. We did get a green bar sell here. And I'm going to show you something. You see how the market broke the trend line here to the top side. We haven't had a test of the extreme, right? So even though the market is trying to get more bullish, we haven't had a test of the extreme yet. So for those of you new in the room, you're wondering what the heck is a test of the extreme? Well, a test of the extreme, before a market can reverse, it needs to retest, in this case, the lows. It's very rare for a market just to make a flat out reversal, or what is called a V bottom, which would look like this, or the opposite would be a V top, right? It's not that it doesn't happen, but it's rare. What tends to happen more often than not is that the market, if it's in a downtrend, will make a test of the extreme being right here, this low, and then it will reverse and tell us that the market's going to head higher. Same thing here with the if a market's in an uptrend, it will tend to test the extreme being the high, and then fail and show us that, in fact, the market is prepared to head lower. So when you got this green bar sell signal on the hawk, and it looks as though the market is trying to get more bullish because we've broken this little trend line that we've drawn here across the highs, I wouldn't be in a buying mood just yet. You know how we shorted this market, or this signal right here. This is the opposite of the green bar buy. It was the red bar sell. But we had the test of the extreme, right? The market was in an uptrend, came down, came up short of the high, the extreme, and then reversed. That's what made selling this a little bit more predictable. Compare that with what we have down here. We don't have a test of the extreme yet. So if you could certainly set up to buy the high, you know, the reversal signal, but it's probably best for you to go with trend in anticipation that the market may try to retest these lows first. You can see that it did in fact do that. It hit our profit objective, and now they're still kind of floundering there a little bit. Oh, and actually continued lower. So we got another green bar sell, and the same idea, and it looks like the market is now retesting those lows. So that's what made this signal and this signal here more of a with trend signal than the other one we were looking at. All right, so if you're trading the hawk, there's a little tip for you on your hawk trade. Here's the E-mini now on the Raptor. And the E-mini is going to follow the NASDAQ and the Dow pretty closely. In fact, Marsh Jones, the late Marsh Jones, used to have a strategy where he wouldn't even watch the charts. He'd actually just watch the time and sales on the NASDAQ and the Dow. And if you saw the NASDAQ and the Dow both make a spike and head off in one direction quickly, he would place an order in the E-mini because the E-mini actually lags by a few seconds the NASDAQ and the Dow. So that was his observation. Okay, so I'm actually running the standard settings here on the E-mini. You could speed it up with the Raptor because the E-mini is a $12.50 per tick instrument. You could go to our default settings and actually speed this up somewhat. Let's see what this is going to look like on a 4-tick bar. And the only reason for doing this is that at $12.50 a tick, we may not generate enough signals to trade intraday. So if you ever run into a market that is not giving you enough opportunities, if the session break lines are too close together, then you may want to consider speeding up your chart a little bit. But for 99% of the markets you're looking at, the default settings are the ones you want to go with. Unfortunately, the E-mini, being one of the world's most popular markets, is the exception, unfortunately. All right, so let's see what we had going on here this morning. The market opened here, came up, retested the highs, and didn't really get anything tradable just yet. While it's in this cloud, we're always a little bit suspect. We would anticipate a hard edge bounce off of the cloud here. It didn't produce. The market actually showing us sell signals, kind of reminiscent of a rule of 3 in the Eagle. And then here we're getting our trend change signal. So the E-mini also starting to look a little bit more bearish, but this would have been your first signal right here on the Eagle, this cloud crossover. Now, when the cloud does cross over on the Raptor, remember, sometimes or very often we will see the market retreat and come back into this cloud. Let's see if I can find you another example. Okay, here, maybe I can show it to you on the NASDAQ. It might be a little bit clearer. The principle is going to remain the same. When the market changes trend, so you see how the cloud crosses over and we produce a signal, pardon me. Very often when this cloud crosses over, the market will come back into the cloud, and that cloud is going to lend some support to the market. It comes out of there, generates a signal. This is going to be your higher probability signal now. And we took a little bit of heat, but the market eventually fell off and headed lower. As you can see, the NASDAQ a little bit more cooperative in that respect than what we're seeing here in the E-mini. The E-mini a little bit slower to respond, but we should still anticipate that cloud crossover and that opportunity to sell it. Okay, a couple great questions from you guys here, so just bear with me. I'll get to each of them. First off, Richard is asking, this is a very common question, by the way. Richard is asking, what qualifies as a test? Is it any price movement towards the extreme and then a break against the trend? Short answer, yes. The longer answer is, you have to, trading, you take a lot of things in context. So the short answer is, if it looks like a test of the extreme, it's a test of the extreme. Fib traders get all excited because, they start pulling fib lines and they start saying, oh, okay, well, the market made a 62% retracement, or it made a 50% retracement, or in some cases, it only made a 38% retracement. Really, it doesn't matter. This is why I don't subscribe to Fibonacci retracements all that much. And now, if you're a fib trader, I don't mean to burst your bubble. There's nothing wrong with following Fibonacci retracements. It's just, really, what difference does it make if the market retraces 38%, 50%, or 62%? It doesn't. The fact is that the market has retraced. Okay, now what I mean by taking things in context is, we've had a market that's been in a fairly reasonable uptrend here since about 6 o'clock this morning, Pacific time. So we've got a market which is uptrending, and now all of a sudden, the sellers put a stop to it. The sellers force the market down. Do you think, given that the market has rallied from 42.82, that the buyers are just going to walk away from this rally? No, it's not likely. If the market had rallied from here, or here, we'll even do this. If the market had rallied from here to here, if this was the extent of our rally and the sellers step in, is it likely that the buyers will walk away from this rally? Sure. Why not? They're not very strong yet. They've made a little bit of a rally, right? A short little 10-minute or 5-minute rally. That's nothing. But when you take a look at this context, the buyers have been pushing the market higher for about a half an hour or so. And they picked up a very strong rally out of the open. The market opened here, and they had some very good momentum, just boom, 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 just keep pushing higher, higher, higher. Now, all of a sudden, the sellers say, oh, no, that's it. That's as far as you go. Sellers push the market down, buyers push back. Does this look like a reasonable attempt to regain the market trend? I would say so. And that's what makes this a test of the extreme. Now, the test of the extreme, Richard, you're right. It's confirmed when the market actually breaks this low, because now we have made a lower high. Right? The most basic definition of a trend, most basic definition of an uptrend, is the market makes higher highs and higher lows. Right? That's the most basic definition of an uptrend. A downtrend is just the opposite. The market starts to make lower highs and lower lows. The fact that the market takes out this support level right here means that we will see a lower low form somewhere. Right? It's just very basic. It has to. It's making lower highs. Therefore, if it breaks the support, it must make a lower low somewhere. So, short answer is, if it looks like a test of the extreme, it is a test of the extreme. And it's a very simple exercise. If you just go to any trend reversal, you will see this happen. And sometimes the test will come very deep. Again, this is why I don't pay a whole lot of attention to the fib levels. If we were watching the fib levels, that's 100% retracement. Well, what difference does that make? Whether it's 100% retracement or a 50% retracement. Or, if it was a 38% retracement, then we'd really be lost. No, if it looks like it's tested the lows and failed to recover the trend, then that's exactly what has happened. So in this case, it appears as though the market is no longer able to maintain the lows, and therefore it's going to try to retest the highs. And now we've broken the highs and everything is confirmed. We get our buy signal and away we go. All right. Now this is going to happen on all the charts. It doesn't matter whether you're a Raptor trader or whether you're a Hawk trader or a Falcon trader. See, here it is on the Raptor. Nice little test of the extreme. We get our reversal signal. Now when we get our sell signal, our counter trend sell signal here on the Raptor, this would be what we refer to as our soft edge sell. It must always be preceded by a test of the extreme. Always. There will be occasions where you will get the soft edge sell or the soft edge buy, and you will not have the test of the extreme, and occasionally it will work out. But by and large, you need to have that test of the extreme. Now look at this. We've got a test of the extreme here, don't we? If we produce a soft edge buy, yes, it's a counter trend signal, but there's a good possibility that we will see a little bit of a rally here. How can I say that? Well, because the market is currently contending with the support. Right? It's having a harder time heading lower. Here, same thing on the Eagle. Now, see, this one would have been tough to spot on the Eagle. If you were solely watching the Eagle here, this, in hindsight, it turns out that was our test of the extreme. Although I suppose you could, again, if you're looking at this in hindsight, you could say, well, there was the test of the extreme right there. But you can see here on the Eagle, this time it was very difficult to spot. Now we did get a subsequent signal here on the Eagle. This is our trend change signal, or I suppose this would have been the first one here. But regardless, you had a couple opportunities to short here on the Eagle. And admittedly, this one would have been a little bit more difficult to capture than on some of the other tools. Fortunately, regardless, it did have a good result. And here I'll just show you, last but not least, here on the Falcon, so you can see what it looks like. Again, a test of the extreme. And that's actually part of the basis of our trend change signal. Right? The trend line changes color, we get the down, we get the up, which fails to recover the high and the trend. And then we come back and we get our sell signal. That's what makes that a high probability signal. Here we've had the reversal. This is actually an early trend change signal. And again, we've had our test of the extreme. Market comes back, produces a signal. The trend line wasn't in sync yet. That's what makes this an early trend change signal. Much more difficult trade to take, but you can see even so, we had a decent result from that. All right. So very good question. Brian is asking, do you like crude oil at 8 ticks because it's at $10 a tick? Now, I'm assuming you're asking about the Raptor. If that's the case, yes, I will stay with an 8-tick crude oil chart on the Raptor. Like I said, 99% of the markets you're looking at, you'll stay with the default settings. The E-mini, unfortunately, is the exception that proves the rule. If the E-mini did not trade well, even if it traded at 12.50 a tick, here, let me show you. I'm going to reload this E-mini chart on the Raptor. I'm just going to change my E-mini chart back to 8 ticks, and then I'll pull it over so that you can see. Okay, we'll just let that reload, and then oh, Mark's asking, Eric, good morning. Remind us, Raptor traders, what the default settings are, please. Sure. And we'll just, the default settings, again, for 99% of the markets you're interested in, will be an 8-tick chart. And I think this is going to answer David's question. David says, it looks like you have 3 clouds. I only have 1. I'm running 2 clouds. And this is something that Ricardo, one of the Raptor owners, posted at the Raptor forum, at the Raptor Facebook forum. And it seems to be working pretty well. What Ricardo was doing is he was experimenting with hard edge bounces. And he found that if he had 2 clouds, he was able to take advantage of bounces like this, where the market actually overshoots one of the clouds. So it's very simple to do. So you have your default, or I have a default 12-tick cloud, and then I also have a cloud which is set at 8 ticks. And to get the second cloud, all you need to do is you need to go here into your indicator warehouse tools and find your Raptor cloud. Double click on it, and you're going to see you get an extra Raptor cloud in your assortment. Then all you need to do is, so you don't confuse the 2 clouds, is just change the colors. So I changed the color of the band, and I changed the color of the band edge. And you can choose any color you want, just so that it's different from the default band. And then when you click apply and OK, then you're going to have two bands on your chart. And like I said, the sole purpose is just to help you take advantage of those deeper hard edge bounces. You see here was a deeper hard edge bounce. The market comes out, generates a signal, and that had some good follow through to it. Plus, it looks kind of cool, I have to say. All right, we're getting a possible buy signal here now on the Raptor. Is this market going to try to recover some of that early decline? What we could do is we could set up to buy above this high. And what I'll do is I'll put a runner on here as well. So you can see we're coming back with yet another buy signal. I'm going to look to buy above this high. This is a little bit riskier, folks. If you're looking to follow on a trade, this is definitely a more difficult trade to take advantage of. And that's because the trend is obviously down, right? We don't want to get too excited about buying counter trend. All right, I'm going to put that on the shelf, and I'm going to bring back this E-mini chart. So this is the E-mini at the default settings. Oh, and it didn't draw my daybreak lines. Okay, so we've got a session here. Oh, there we've got a session. Well, that's just the overnight, sorry. And then we had, oh, actually the Raptor seems to be performing a little bit better with the default settings. Okay, my mistake. Yeah, okay, with the Raptor you can stay with an 8-tick bar. The problem is if we were using, say, the Falcon, our daybreak lines would look like this. Oops. Sorry, get rid of that. Our daybreak lines would look like this if we were using the Falcon, which is our other 8-tick tool. And you can see that for trading intraday, you're just not generating very many signals. If your chart looks like this, if the market you're looking at looks like this, then what you want to do is you want to dial down your brick size. But again, for 99% of the markets you're looking at, oops, sure, might as well put this on here now, seeing how I pushed the wrong button. For 99% of the markets that you're interested in, the default settings will work just fine. And if you're ever confused, you can send me an email, but don't be surprised when I write you back and say, for 99% of the markets, the default settings are the ones you want to go with. Okay, I think that was everybody's question. Looks like the NASDAQ here is flirting with our highs. Now, you see, this looks like a test of the extreme, doesn't it? The sellers trying to recover the trend. They failed to take the trend back. We actually had a soft edge buy signal right here, so you could already be long this market. Appears to be a lot of support around this whole 42.65, 42.70 area. So we'll see how this plays out now, whether or not this actually ends up pushing the market a little bit higher. Oh, what a struggle. All right, I would say this is the last chance for the sellers. Pardon me, if they don't recover it here. I think we're going to see it press a little bit higher. A little bit of floundering. All right, here we go. Okay, so I haven't engaged my stop order yet. What I'm going to do is we'll do one of these. And now the Trailblazer will automatically manage my trade for me. And all I'm doing is I'm holding this one in, hoping to hit that break-even trigger and get to that first profit objective. There we go. Okay, don't let me down now. Come on, let's go. Interesting question here from Mark. Mark's asking, can you add the support and resistance suite indicator to your Raptor chart? Absolutely you can, Mark. In fact, there it is on the E-mini. These lines that you see here. So the gold line is our median line. The blue line is our primary resistance, and then we have our primary support. And then we get our secondary lines above and below. And you can see as far as the E-mini goes, we've pretty much been stuck between the primary support and the primary resistance for the most part. We took a little bit of a blurred the primary resistance level a little bit, came back here to the median line, and now it looks as though the market's trying to rally a little bit. You can add any of these add-on tools to any of your birds. For simplicity's sake, I've only got one tool per bird, and that's just so things don't get too confusing. So here on the Raptor, I happen to have the Geiger counter. On the Falcon, I have the support and resistance suite. On the Hawk, I have the Day Ranger, which is this tool up here. And on the Eagle, I have the Trade Forecaster, which is this tool right here. But I could have all the tools on every single chart. However, the information is redundant. So even if I add the support and resistance suite here to the Raptor chart and the Eagle and the Hawk, the lines will be exactly the same values. So for me, I don't find it inconvenient just to glance here at my my Falcon chart and say, oh, okay, primary resistance is at 42.86. I hope that makes sense. Gary's asking, he says the Geiger counter seems to take a lot of CPU. I don't know if it does, Gary. The Raptor in general, and I don't know why this is, it takes a little bit longer to load. Probably because it has all three birds on one chart. I don't think it's the Geiger counter itself, though. Now, I'm no programmer, but I don't think it chews up that much memory. All right, so our buying attempt, short-lived. The Raptor came back here with another sell signal. So our second band still bearish. Came back with a sell signal. Now we have a really big test of the extreme. A double bottom, if you will. Well, thank you. Happy New Year to you too, Suncomes. Suncomes saying Happy New Year. Yeah, so far we've had a very nice start to the year, trading-wise. The advanced decline numbers have flip-flopped quite a bit. Jim says we've got 1,200 on the buy now and almost 1,600 on the sell. So he's saying it's looking like the bulls are in trouble. They're getting a little bit weak, and it does appear as though that is in fact the case. With that quick little rally to the downside. Friday's lows, where were Friday's lows? I guess, is this Friday? Yeah, this would be Friday. 42.60, does that sound about right? So it does appear as though we are retesting Friday's lows at the moment. Or something close to it. Just waiting for our next opportunity. You can see we're sitting here on the median line of our support and resistance assortment. Buyers definitely getting a little bit stronger here now. Okay, good question here from Mark. Mark's asking about the break-even settings. And he's a Raptor trader, so let's go here to our Raptor. First, let me go over the break-even settings for those of you who don't know how to set your break-even. The break-even is part of the Trailblazer and or Trade Manager. They both work the same way in this respect. So you're going to take your Trailblazer. If you already have your Trailblazer turned on, you need to turn it off. So you need to go here to Enabled, and you need to go to False, and you have to remember to apply. You'll know it's turned off when it's disappeared. Now if you go to the very top, you're going to see Auto Break-Even Parameters. If you do not have your break-even turned on, this is going to say false. So what you want to do is you want to go to True to turn your break even on. And now you can set your break even triggers. Personally, I think, or I like to set my break even trigger to about 80% of my profit objective. 75, 80%. I figure if the market's going to get to about 3/4 of the way to my profit objective and then fail, well, I'd rather be out at break even than a loss. So in this case, the default is 15 ticks. You're going to see here in a moment on the Raptor, I normally run a 20 tick target for my first profit objective. So this is fine for me. And I'm going to have break even +1. I'm going to have the tool automatically roll to break even +1, so at least I get enough to pay the broker. When everything is to your liking, you go back down here to your enabled tab, and now you make it true, and you apply, and everything's going to be set up. Now, what Mark is asking is this trade that we did back here. He says, I saw you used it on the Raptor. I'm still trying to wrap my head around it. The question that Mark emailed me about is, why do we have a break-even function here and the auto break-even? Well, the one is just automatic, right? So we set up the trade to enter here, and I got my auto break-even 15 ticks further, and then my profit target was a little bit further than that. Again, the logic is if the market's going to bring me in and get 3/4 of the way to my target and then fail, I want to, so actually my target must have been up here. So I get 3/4 of the way to my target and then the market fails. I don't want to leave my stop way back here. If it can't hit my first profit objective, I'm going to roll it up to break even +1. The market came down, stopped me out. Now, occasionally, you will find that this strategy stops you out prematurely. If the market is, in fact, reversing, it may have come down like this and then started to reverse and head higher and eventually hit my profit target. And meanwhile, I'm stopped out at break even. That can happen. But of course, in trading, we don't really know what's going to happen next. So you need to protect yourself the best way that you know how. And for me, this makes sense, right? If the market's going to get 3/4 of the way there and fail, go ahead, take me out of break even. I'll look for the next opportunity to get in. In this case, it worked out well for me because had I not done that, I would have taken a loss down here. My stop was down here. So rather than take a loss, I at least managed a $10 profit, which will more or less cover my brokerage fees. Now, Mark is also asking, can the tick size of the break-even Trailblazer setting be changed right before you make a trade? Or is there an optimal setting for this? Well, you can change your settings anytime you like, but you do need to go into your strategies window, just like I showed you. You need to turn it off, and then you need to go up here and you need to make your changes, and then you go back down and you turn it back on. So it is not something that you're going to do on the fly. Is there an optimal setting, Mark asks? I think, as I've mentioned, anywhere from 75 to 90% of your profit target. So here on the Hawk, for instance, we're getting a first micro macro cross signal. Haven't had a real good test of the extreme, so don't be too excited about following me on this one, but I'm doing this for demonstration. You're going to see the break even engage after the order is filled. That's at 8 ticks. I have a 10 tick target. So my logic is if the market gets 8 ticks to my profit objective and then fails, go ahead, take me out of break even. Here on the Eagle, and again, don't follow me on this, I'm just showing. Let's see if it dips here a little bit. Come on, get down there. Come on. Okay, you see my break even, I'm running a 40 tick target. My break even, I think, is at 25 or 30 ticks. Again, the idea is if it gets 3/4 of the way to my profit objective and then fails, go ahead, take me out of break even. Because the whole point of the break even trigger is to improve your overall profitability. Right? It's much better to take a break even trade than to take a losing trade. So if the market almost always moves in your direction, at least for a little while. So if the market starts moving in your direction, go ahead, take the trade to break even. And if it reverses and stops you out, well, so what? So you got stopped at break even. It's always better to be stopped at break even than to take a loss, in my way of thinking. Mark is also asking, is break even used as a typed stop loss setting? No. Now this is going to be less evident for those of you who are using the Trailblazer, because the Trailblazer does not have the risk manager component built in, but you can still simulate it. You see here on the trade manager, we have this risk component where every single trade is going to be limited to 2% of my trading capital. So watch what happens. If I set my trade, you're going to find that I'm not one for setting my trade very, very tight. So let's say we looked at this signal right here. The tendency for most traders is to set up their trade really tight, right? To put their stop loss as close to their entry as possible. Why? Well, because they think that that's the easiest way to risk less money. The problem, of course, is that you put yourself within the market's immediate range and increase the likelihood that you're going to get stopped out for a loss. What the risk manager does is it always limits my risk to 2%. So regardless if I put my stop right here, notice my risk amount is $300, or if I place my stop, say, down here, my risk amount stays more or less the same. And yet, which trade has the higher probability of success? Now, we're talking probability of success. We're not talking risk-reward ratios or anything like this. Which trade do you think is more likely to work out? This one or this one? Well, it should be, a bit of a rhetorical question. Obviously, the trade with the bigger stop has the greater probability of working out. It is more probable that the market will find my profit objective on this trade before it finds my stop loss than this trade. Had I set up the trade this tight, I would have just incurred a $300 loss. Now, what you need to do if you're running the Trailblazer is you need to know your average position size. So you need to know that, okay, on average, if I set up the trade, to enter here and I run a stop about here, okay, I'm going to be running 2 contracts more often than not. So that's how you simulate it on the Raptor. So when you go here to your Raptor now, and you set your position size, well, whatever. Let's say you're looking at this signal right here. I'm going to have one contract, and let's say I'm going to run that one at 20 ticks, and I'm going to have my second contract just be a runner. I'm not going to run a third contract, or, say 2 contracts there and 2 contracts there. I'm not going to run 4 contracts, because I know that most times that's going to be risking more of my trading capital than I can afford. So if I'm trading, say, a $10,000 account, that means at no time should I be risking more than $200. That's 2% of $10,000. Generally speaking, anything less than 5% is considered prudent. So if you're running, between $200 and $500 on a $10,000 account, that's not going to wipe you out. Or if you're trading a $20,000 account, of course, it's going to be anywhere from $400 to $1,000 on a trade. Ideally, you want to risk less versus more. So that means when I set up my trade here, I need to know that more often than not, if I take that sell signal and I choose to place my stop up here, this is going to fall within my parameters, so I can take 2 contracts. What you don't want to do is, and this trade worked out, but occasionally, you're going to take a little bit of heat on a trade. What you don't want to do is you don't want to put your stop right here. Because if you get engaged, the market makes a little bit of a hiccup, stops you out, and then, goes on to your profit objective. It's adding insult to injury. Not only did you miss out on the profitable trade, but you also incurred a loss for your trouble. Now, admittedly, here with the Trailblazer, this loss would be much less. This might be like a $100 loss. This would be a $300 loss. But a loss is a loss, right? The whole point of your stop loss is not to maintain some sort of fictitious risk-reward ratio. The whole point of your stop loss is that this is a safety net. This is here to prevent you from blowing yourself up. And I've met people who have blown up $20,000 accounts in a single session. Don't ask me how that's possible. I still can't wrap my head around that. But it does happen. So your stop loss is nothing more than a safety net. You're on a tightrope, you're taking a trade. This is here to prevent you from blowing up your account. And this amount of risk should be ideally between 2 and 5% of your trading capital. But at the same time, you don't want to run your stop so tight that you end up strangling your trade, stopping yourself out before you incur or have a chance to realize a profit. I've shared this story before, but seeing how we've got some new owners in the room this morning, a fellow who I was coaching phoned me up one day, and he was quite distressed. He says, "Eric, I just lost $800 in gold." And I said, "How in the world did you lose $800? I just made $1,000 in gold." So here we are trading the exact same market at the exact same time. He loses $800, I make $1,000. Well, he was strangling his trades. He could not wrap his head around the idea of leaving a reasonable stop and maintaining his risk by controlling his position size. He insisted on running 6 contracts with a very tight stop. Well, that was great. If the market actually moved in his favor, he'd have 6 contracts making money. I would only have 2. However, the time that the market made a little bit of a hiccup, all of a sudden he would lose, say, $500 on a trade. And if the market reversed enough to hit my stop loss, I would only lose 300. So he was doing the exact opposite of what you're supposed to be doing. You're supposed to be losing less and making more. He was losing more and making less. So, that's the takeaway from this is don't run your stops so tight that you get stopped out prematurely. Give your trade a decent chance, but make sure that this risk amount is an amount you can afford to lose. Believe me, that takes a whole lot of stress out of the trading equation. And a loss is unpleasant. Nobody likes to lose money. I don't like to lose money. But if I'm going to take a loss, let it be an amount that I can afford. Right? It's a lot easier it's a lot more palatable to take a $300 loss for me, for my account, than to take a $1,000 loss. Right? I remember, before I got a handle on this early on in my trading career, I took a hit one day for $800 or $900 or something. I was miserable all week because I knew I had lost too much money. I knew I lost more than I could afford to lose. If I had lost $300 instead of that 900 or whatever it was, I'm sure I would have been upset, but it was an amount that I could afford. The $900 that I lost was not an amount I could afford to lose. So I got up on my soapbox there a little bit, but it's such an important concept. So the break even is not used as a tight stop loss mark. It's there to kind of make the market prove you right. A lot of times I had a trading friend who used to say when he took his trade, okay, kill me or make me rich. Either go on and hit my profit target or take me out of the trade, but don't just flounder. So that's kind of the logic behind running a break even. If you're going, go. If you get 3/4 of the way there and you don't make it, take me out. Mark says, I guess a feature upgrade for the break even could be if we could set it at a percentage of the target rather than a specific tick size. Yeah, I suppose that's possible. What you want to do if you come up, and it's a good suggestion. I have zero control over those types of things. The fellow you want to talk to, who you want to relay your ideas to, is Adam. And you can always send Adam your input at his email, adam@indicatorwarehouse.com. And he does listen to your input. Your input is the reason we have tools like the Trailblazer, tools like the Geiger counter, tools like the Raptor even. These all came about from owners' suggestions and comments. Yeah, I like what Jim says here. Jim says break even is a win. A break even trade is as good as a win. Okay, good. Mark says that explanation about stop loss versus break even was very helpful. Good. I'm glad. Looks like the market's in a little bit of a rally mode here at the moment. They're probably going to start. Oh, I was going to say we're near today's highs, but no, we're not. We're just kind of back at these highs here. And we're definitely going a little bit sideways now. Pardon me. Looking at a market when we've kind of lost our trend. So we might be on hold here for a moment, still nursing this crude oil trade, and I'm seriously considering taking the open profit. We've got about $200 here in profit. Seriously considering punching out with that. Oh, although here they are, they're trying to make a poke at the low now. So still kind of nursing that trade a little. All right, you guys, doesn't look like we've got a whole lot going on at the moment. Excuse me just for a moment. I've got to get a drink of water. I'll be right back. Okay, I'm back. What did I miss? Oh, it doesn't look like too much. Looks like the market's still floundering a little bit. Oh, crude oil is making its way to our profit objective rather reluctantly, but we are getting there. Oh, it's almost up 300 on the trade. It was up 300 at one point. Again, very tempting just to pop out with that $300. I might do that still. $100 is a lot of money, but $300 is more, obviously. The The NASDAQ still looking a little bit bearish, floundering somewhat here on the hawk. You can see we're starting to get this roller coaster effect. A lot of yellow bars. Ditto here on the Falcon. Trend line is waffling. The advanced decline evening up a little bit. Jim says we've got 1,300 on the buy, 1,500 on the sell. So that's fairly even. It does look as though the sellers are getting a little bit stronger. It looks a whole lot like a great big trading range right now, though. Notice the test of the extreme right here on the eagle. We got a rule of 3 signal, which was actually only 2 signals, but it was preceded by that test of the extreme, that all-important test of the extreme. Jim says the DAX is sitting on the primary support line, so that may lend some support to the market. We're back near the lows of the day. Come on, crude oil, just about to our profit objective. Come on, crude. Get down there. And what I'm going to do is I'm going to take my stop and roll it right there. Only going to give it that 1 bar. And in fact, I might even choose to roll it in above the high of the current bar. Where is that? That's almost $300. There we go. Protect 300 with a chance to make another 100. And it looks like that's what they did. They just reversed and stopped me. So we managed to take $300 out of that move. Well, the NASDAQ just kind of stuck here at the moment, which is not unusual. We're getting near the top of the hour. And I've actually got an appointment in a half an hour, so we're going to close up the room here in a few moments. So if anybody has any burning questions, now's the time to let me know. Oh, I did. There we go. Clean up all my charts, make them all pretty. Sure, Mark asked, can you discuss the wide and narrow bar thingy? I forgot its name. Dynamic equivolume bars. They're most prominent here on the Falcon, I think. The dynamic equivolume bars is an add-on, and again, it will work on any chart you can place on NinjaTrader. So it works on tick charts, it works on range bars, it works on, well, pretty much anything, except things like point and figure charts, obviously, Kagi charts, those types of things. The dynamic equivolume bars is an easy way to incorporate volume into your price analysis. The wider bars have more volume associated with them. The narrow bars have less volume associated with them. Why is that important? Well, there's always volume when the market changes direction. So if you're looking at, say, a signal like this is an early trend change signal, but notice the volume on these bars before the signal generated. Here is a late filter entry signal on the Falcon and a high probability signal for us. But again, look at the volume that came in just as before the signal generated. You're going to notice that when the market is trending, there's usually very little volume associated. Why? Well, because in this case, the market's going down. The buyers are not giving the sellers any grief. Look at where the buyers did try to dig in, though, right at this old support level where they dug in the last time. So then when this support level ended up failing, the buyers try to buy it up, the sellers knock it down a little bit, buyers try to buy it up again, and the sellers come back and knock it down again. Then we get our late filter entry signal and a good selling opportunity. So that's a very easy way to bring volume into your analysis. And like I said, it will work on any of the charts, not just the DTS charts, but even if you're looking at, say, a 5-minute chart or a tick chart or whatever. Here's the dynamic equivolume on the Raptor, and you can see same thing. It confirmed our cloud crossover signal. The width of the bar is telling us that there's a lot of activity here, which is typical when the market changes direction. Notice here, now that we're in a trend, we don't really have a lot of width associated with these bars. The volume is relatively light. There's not a whole lot of resistance on the part of the sellers, or pardon me, the buyers. Yeah, Gary says he likes his a lot. I think they're a great tool as well. And we'll close today's session with Randy's question. Randy asked, what is the stop limit used for in the Trailblazer and Trade Manager? The stop limit is this feature up here, and it's both on the, as you pointed out, on the Trailblazer and the Trade Manager. I don't use limit orders very often. Limit order is when you're looking to sell the market at a predetermined point. What I tend to do is I tend to use what are called stop orders. And a stop order is, so for instance, I expect the market to head lower. I'll place an order to enter down here. If prices go lower, they'll fill the order. If prices don't go lower, my order never gets filled. That's a stop order. A stop limit is where you try to say, okay, I've drawn a trend line here. I'm going to sell if the market hits 42.58. Now that's just a pure limit order. A stop limit says, okay, I'll sell 42.58 to 42.59. So I've allowed 4 ticks. So I'm going to place my stop limit order, and I'm going to sell 42.50. Well, here we'll do 42.57, and my stop loss is going to be up here. Now notice my limit order is 4 ticks, so I've allowed the market to fudge my order by 4 ticks. All right, so it allows a range where you will say, okay, anywhere between 42.56 and 42.57, I will sell the market. It's not as precise as a stop or as a flat out limit order, where a limit order has no fudge factor. So let's say I'm going to sell 42.57. I sell 42.57 and that's it. The stop limit gives you a range that you will accept your sell order or buy order within that range. Normally you use limit orders on things like support and resistance lines, or if you anticipate reversals off of trend lines, or if you have a market which is obviously range bound. Here, I'll show you here on the, if we're trading the Eagle and we have a market which is range bound, there were traders who were saying, okay, I'll buy at 42.62 and I'll give the market, say I'll buy on a 4-tick range. So they'll buy, 42.62 and they'll put their stop loss probably down here, and there's your profit target. Oops, sorry, I'm on a stop. I need a stop limit. So let's say I'm going to buy 42.60 and I'm going to place my stop there. So now I've got a limit to buy between 42.59 and 42.60. That's the range I'm prepared to buy at, in anticipation that this whole support region is going to hold. And you can adjust this once it's, oh no, sorry, you can't on this one. You can on the Trailblazer, because the Trailblazer orders are live the moment you put them on your chart. The Trade Manager orders are not live until you submit them and they get filled. So in this case, the market comes down, and actually I should have done this over here because you can actually see where the limit orders came in. So people looking to buy 42.62 and their stop loss, say down here. All right. So we have a 4-tick range, but look at this reaction as the market gets down to these lows. There were traders buying on limit orders and stop limit orders around this 42.63, 42.64 area, because look at the reaction we got. It was short-lived because they all got stopped out. And look at the size of this bar here. I can tell you that this is where a lot of stop loss orders were sitting. They were sitting between 42.60 and 42.58. The people who were trying to buy here had their stop loss orders right here, because look at the size of this bar. This is a lot of stop orders, a lot of exit orders getting filled from this buying, where traders anticipated this range to hold and that the market may rally back up to the top end of the trading range. So those are limit orders and stop limit orders. I don't use them very often because they're a little bit more predictive versus a stop order, which is reactive. A stop order says, okay, I've got a test of the extreme, I've got a rule of 3, I'll sell below there, I'll place my stop here. If the market heads lower, it will bring me in, and I'm in the trade. If the market does not head lower, let's say the market heads higher from here, my order is never filled. All right, so those are the differences between those tools. Oops. All right, you guys, we're going to button things up now. Like I said, I've got an appointment at the bottom of the hour, so I got to get ready for that. And I will see you guys again tomorrow morning. If you are trading the rest of the day here, I would definitely be more bearish on the day than bullish. I do anticipate that we're going to see another pullback, but just look at that as an opportunity. Any rallies, look for those as opportunities to sell the market further. All right, catch up with you tomorrow then. Have yourselves a wonderful day. Talk to you soon. Bye for now.